Now, as you know, gold is a hot topic at the moment, and the current environment in which it's trading, there are a lot of pressures which suggest that the markets could face some headwinds in the future, but gold could well be the standout. That's certainly the way that the gold bugs look at it. But if you look at some of the metrics, it's interesting to see how gold has performed against a number of stock market benchmarks. So we're talking now for gold against Berkshire Hathaway with Simon Popple from the Brookville Capital Intelligence Report. Simon, good to talk to you. When we spoke about this comparison between gold and Berkshire Hathaway, I had to look up the chart and just see, and you were pointing out the fact that we've seen an outperformance of gold over the last 20 years against Berkshire Hathaway. But first, before we take a look at the chart, I just want to get your view on why we should be looking at these two set against each other as a way to measure gold's improvement.
Well, I think the thing is I like many people view Warren Buffett as the guru of investment, and I was very surprised when I saw that gold had actually outperformed what I think many view as his flagship fund in Berkshire Hathaway over the last 20 years, because what we're seeing here is just a simple investment in physical gold. And we're not talking about the miners or anything more complex. Just simple investment in physical gold. The price has outperformed what many view as one of the best investors in the world.
Yeah, I'm interested as well. I mean, we're talking here about this 20-year picture. Let's take a look at the price chart, if we can, in the short term. Now, this is over the last year or so, and you can see clearly in the last year the way in which things have happened. I'm most interested in what's happened recently. If you overlaid that orange line, which is the Berkshire Hathaway line, on the performance of Berkshire Hathaway's benchmark back in 2000, you'd see a very similar sort of pullback, because Warren Buffett never really appreciated the tech boom, and in fact was one of the outperformers subsequent to that. But his index lost a lot at that time. What is it that gives you confidence to suggest that Warren Buffett's not going to bounce back and gold is going to pull back? Why are we not? Why is this a different set of conditions?
Well, I think a lot of it has to do with the current situation in terms of the COVID-19, because the situation out there, there's huge uncertainty, and I know that Warren Buffett has done very well out of stocks that generate a lot of cash, and in many cases, pay a dividend. And because of the pandemic, that a lot of companies have struggled to continue paying their dividends. Many have stopped them, and others have, significantly reduced them. And I think that because gold companies have shorter supply chains that we discussed in another interview, I think that over the foreseeable future, they're pretty well placed to keep paying dividends. And I think that a lot of investors, especially with negative yields on a lot of fixed income products, are going to be looking for dividends to provide them with an income. And therefore, I think gold and gold companies, could do very well.
What about gold itself? What is it about gold that we should appreciate at the moment that gives us some sort of confidence that we've got some upside to come? What are you looking at in terms of some of the issues around gold at the moment to suggest a higher print than we've got at the moment, which is what, 1780 or so?
Yeah, I think there's various things that sort of underpin the price at the moment, which are really, it's a safe haven asset. People, it's got form. It's been around for thousands of years. And, I know there's other things like Bitcoin, which are more recent assets that, could well do, pretty well in this environment. But gold's been around for thousands of years. It's got form. And so I think a lot of people, like the idea of having some gold in their portfolio.
How can you benefit if the price of gold goes up? What is it you're looking at in ways of investing and buying into this product to give you the advantage of future opportunities?
I think a lot depends on your appetite for risk, because if you've got a lower appetite for risk, then you probably want to think about just acquiring physical gold through a reputable dealer. And yes, you'll pay a small premium for it, but they'll store it for you, and then you can sell it at a future date. In a way, I think you can view it almost as insurance as much as an investment. And then if you've got a higher appetite for risk, there's obviously the mining equities, where there's leverage to the gold price. And what I mean by that is if the gold price goes up, it tends to go up more than the all-in sustainable costs go up. So as the gold price goes up, the margin of these companies often expands. And obviously, you've got a higher margin, you've got greater profitability, more cash generation, and the returns from miners can be incredible.
What sort of miners are you talking about in the Brookville Capital Intelligence Report?
Well, what we do is we try and cover all the miners because everyone's got a different appetite for risk. I use a fantasy football format to try and explain the difference between lower risk and higher risk mining companies. But where we've had some really good gains have been in the forwards, which I view as the explorers. I gave Chalice out as a freebie on the website, and that's that went up sort of 10 times in value. So the explorers, if you get it right, then the returns really can be incredible.
You're talking about Chalice, one of the smaller ones, the more risky stocks. What about those that have a long track record and are more, should we say, reliable? I don't want to indicate perhaps maybe that the smaller ones aren't going to be reliable or an upward facing gold price, but how about those that have been around longer, the larger companies with a wider spread of assets around the world?
Yeah, I mean, typically I view those as much lower risk. I think the only thing I'd caveat at the moment is because of the pandemic. I mean, hopefully we won't have a second wave, but I mean, if there is a second wave or even a third wave or whatever happens, then producers, not only do you have to look at the gold price, and most of them are comfortably ahead of the cost, so they can generate a lot of cash. But because they're generating a lot of cash, a lot of them have been comfortable taking on debt. And so you do need to be sort of cognizant of that, and what their debt repayment profile is like. But some of these large companies, they generate huge amounts of cash even with the current gold price. So if the gold price goes up any higher, then the cash returns could be quite spectacular.
Well, let's round it off and go back to the subject that we started off by talking about, and that's the outperformance of gold over Berkshire Hathaway over the last 20 years, but of course also in the last 4 or 5 months or so, which brings into sharp focus the pandemic that we've had. What's the message now to those that are monitoring the price of gold, and what you're talking about to your clients and those that follow the Brookville Capital Intelligence Report about the possible upside on price from this point on?
Well, I think there's a lot of potential for the price to go higher. And I think given the performance of gold over the last 20 years against, such a highly reputable investor, it makes sense to think about having at least some in your portfolio moving forward. And I think a lot of people have got absolutely no gold whatsoever in their portfolio. And I think that, they should at least consider it and, discuss it with their financial advisor, or take a look at my report.
Okay, all right. So Simon, thanks so much indeed for joining. Simon Popple from the Brookville Capital Intelligence Report. You can catch up more with Simon on his website. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.